Hello, this is the audio or narration to accompany the latest set of slides that I've presented or posted on um, the Army Cost Management Certificate course, CMCC Sakai site. I believe the slides are relatively self-explanatory, but nonetheless, I'm providing narration just in case it is helpful and enlightening to some. Now, this topic we're doing is the time considerations in cost-benefit analysis. What happens when benefits accrue over time or costs are incurred over time? And the motivating example that I've given you is this exercise on alpha versus beta helicopters. And in this scenario, the idea is that suppose the Army is going to procure 200 units of a helicopter design, and your choice and the purpose of the cost-benefit analysis is to decide which of two designs should be chosen. And you are told that the R&D so far consumed by each is given by $100 million consumed so far by Alpha, $200 million consumed in the Beta project. You're also given the procurement cost, the first year in which you will actually be purchasing and using these helicopters is FY 2015. And you're given the annual operating and maintenance budget. And for the first 3 years, you have one value. For Alpha will be 50 million and Beta 100 million. But then it changes in the latter 3 years, which is $100 million for Alpha and 50 million for Beta. And the useful life is exactly those 6 years. So we're looking at the 6-year time frame here. And for now, we're assuming that all figures are in constant or real or inflation-adjusted FY15 dollars. And we'll talk about exactly what that means, because that's sort of the point of this lecture today. But what we will certainly be doing is, at this point, by assuming it's sort of constant, real, inflation-adjusted, we are going to at first ignore all of the time considerations. And also, we are going to assume that all benefits and other non-cost issues are essentially the same as well, which allows us to sort of ignore those as well and focus on this as a cost minimization exercise, or really a cost effectiveness analysis, the special category of cost benefit analysis where we assume the benefits are the same and therefore are simply focused on which option has the lowest cost. And the question that I asked you, or the first exercise that we'll be looking at, is the following. Without any adjustments or discounting of future values, right, so we're sort of ignoring the time considerations that we'll talk about, how would the total life cycle costs of the two designs compare? Which design would be recommended in this case and why? And I gave you a spreadsheet that looked something like this. This is the, let me actually zoom in on these. So this is the data I gave you for, in terms of the FY 15, 16, 17, 18, 19, 20 costs. It's in negatives because, again, it's all costs, and so we're trying to minimize the negative here. And the R&D outlays in, for each of the helicopters. And then what I didn't give you before, but what you see here, is that I've actually totaled and summed these up. Now, in particular, what I've done, you'll notice that although I've written down the R&D outlays here, the first sort of trick that you should be aware of is that those don't really matter in terms of making this decision at this point. In other words, those are sunk costs. The expense so far on R&D has already been incurred, so no decision you make is going to recover those funds, and those funds aren't going to affect future costs or benefits. So we can essentially ignore the numbers in column C here, which are the R&D numbers. But if we simply summed up, again, remember these are already adjusted for inflation, so we don't need to adjust them for inflation. If we simply sum up the costs that will be incurred, the first year, FY15, includes both the procurement costs that we were given as well as 1 year of O&M costs. And remember, the O&M costs for Alpha were 50 for each of the first 3 years and 100 for the latter 3 years, and vice versa, the opposite, 100 for the first 3 years and 50 for the latter 3 years for Beta. And if you sum those up, all those inflation-adjusted numbers for the usable life of the helicopters, the designs, we see that the alpha ultimately ends up costing 875 million, beta a total of 850 million over those 6 years. And so based on that alone, the choice would be the least expensive of the two, which would be in fact be the beta helicopter design. And what we're going to do now is, that's sort of the, like I say, the base setup. But what we're going to do is we're going to introduce time considerations and talk about how time considerations will affect our thinking on this. So first of all, generally thinking about the time considerations in cost-benefit analysis. Why does it matter? Well, it matters first of all because recognize that in general, most benefits accrue and most costs are incurred over a multi-year time frame. Rarely will you have a project in which all benefits and all costs incur, at one particular time or at the same time or at the current time. They generally will occur over time, and usually, the cost tends to occur first and the benefit tends to come later. But the problem, of course, is that how do you compare, for example, $1 million in costs now to $1 million in benefits later? Because the reality is the value of a cost or benefit is different depending on whether it comes today or tomorrow. In particular, $1 in the future is worth less than $1 today because of two primary considerations. The first is inflation, right? The fact that prices are going to go up, and therefore the buying power of money in the future is going to be less. And also the idea of the opportunity cost of money and therefore discounting. Right? And we'll talk about that, and that these are, in fact, two distinct considerations. Sometimes they get confused, or they certainly will get combined, and that's the right thing to do. But understand that we're going to analyze these separately because they're actually two separate considerations. And if any effective cost-benefit analysis must, of course, correct for both of these considerations. Now, the agenda today we're first going to talk about inflation, and that's pretty straightforward. And the rest actually, then we're going to get into the discounting aspect by first talking about the opportunity cost of money, right? What do we mean by that, and how, particularly the opportunity cost of money over time, how we adjust for it, that's discounting. Then we'll talk about how we choose a discount rate to appropriately or accurately adjust for the opportunity cost of money. And then we're going to begin to get to putting it all together and how we ultimately get to calculate sort of the net present value, or how do we end up figuring out the net benefits of any course of action when we're looking at an issue over time. And so first we'll talk about present value and future value and how they relate. We will then first actually introduce future value of an individual cost or benefit, primarily as a way to get to our next bullet point, which is the present value of an individual cost or benefit. We sort of explain the future value, we can then back into what the present value is. And then the idea of, once you get the idea of present value of any individual cost or benefit that may be in the future, what are the present value of a cost or benefit streams, sort of over time, a cost that incur regularly over time, either the same cost every year or different costs or benefits every year. And then finally, how do we put it all together and calculate the net present value of a course of action? So let's start with the idea of inflation. And what do we mean by inflation? How do we adjust for it? Now, so inflation is the first reason why we say $1 tomorrow is worth less than $1 today. What is inflation? Well, since you all presumably have some idea of what inflation is, let me give you the OMB Circular A94 definition of inflation. So this is the official, if you will, federal government cost-benefit analysis definition of inflation. It is the percentage change in the general price level, and that's sort of key, the general price level, as opposed to the percentage change in a specific price. So it's not about inflation in one thing in particular, but it's the idea of inflation in prices overall throughout the economy. And it's generally measured by some broad-based price index, right? That sort of covers all prices. Either the GDP deflator or the Consumer Price Index, CPI, are the most common broad-based price index. And what it means, of course, inflation means that future dollars have less purchasing power than dollars today. And therefore, because you'll be able to buy less with dollars that you forego in the future, or dollars that you either spend or receive in the future, then those dollars in the future are therefore worth less because they can buy less. So the idea is, how do we incorporate that into cost-benefit analysis? Well, to understand the dilemma, suppose you have a government program that has a cost of $75 million today and a benefit of $100 million in 5 years, right? Okay, well, the benefit exceeds the cost, but separated by 5 years, right? How do we figure out whether or not it's worthwhile, whether the benefit of $100 million just 5 years from now justifies the cost of $75 million today? And so the way to think about this is like, look, in 5 years, the government will be buying other goods and services, right? So, and we think about the government's ability to buy goods and services, 5 years from now, because therefore the $100 million benefit in 5 years is in some sense cheaper than a $100 million benefit today, or worth less than a $100 million benefit today, because prices will be higher due to inflation, right? Because relative to the price of other goods and services, which will be more expensive, $100 million is less valuable the farther in the future it comes, simply because of inflation. So how do we then make an apples to apples comparison, sort of an equal footing comparison between the cost and benefit in this case, when the cost occurs today, the cost of $75 million occurs today, and the benefit doesn't occur, even though it's larger, it doesn't occur for 5 more years. And to do so, let me define 2 more terms, 2 more ideas that are also defined in the OMB Circular 894. Right? Are nominal dollars versus real dollars, or nominal dollar values versus real dollar values, or current dollar values as opposed to constant dollar values. And when we say current, we don't mean now, we mean current as of the year in which we are referencing. So nominal or current dollar values are economic units measured in terms of the purchasing power or actual values on the date of the event or transaction. So we're talking about, if you receive $100 million 5 years from now, then the nominal value of that is $100 million, exactly what the dollar value is at the time that you either incur the cost or receive the benefit. Right? And these are obviously they incorporate the price level at that time. They don't incorporate any difference in price level because it's talking about actual dollars, right? And these are, again, not adjusted for inflation, so they reflect the effect of general price inflation. So therefore, the $100 million, like I say, that you might get 5 years from now, if it's in nominal dollar values, then in that case would be worth less than if that $100 million was in real dollar values, where it did not reflect any sort of price inflation. In fact, inflation was already taken out of the equation. And that gets the definition of the real or constant dollar values. And these are economic units measured in terms of the constant purchasing power, right? So you they're adjusted for inflation and therefore not affected by general price inflation. So you sort of can ignore inflation if you're given things in terms of real or constant dollar values over time. And again, as we mentioned, we estimate these by, you take nominal values and then quote unquote deflate them using the value of a general price index such as the CPI or the GDP deflator. What do we mean by deflating or inflating? Well, give you an idea of how nominal and real are related. So nominal value is equal to the real value, quote, inflated, unquote, by the inflation rate, right? So if the inflation rate is P, right, then any nominal value equals the real value times 1 plus P, right? So, of course, P where it reflects the inflation rate between the 2 times we're talking about. So, for example, the nominal interest rate, right? If the interest rate is I, so the interest rate that's sort of reported is for example, if your bank says you get a 10% interest rate on some savings account or some investment, right? What that is equal to is the real interest rate inflated by the inflation rate, right? So again, the idea being that if you are earning a nominal interest of 10%, if prices are also going up by 10%, you've really earned nothing. You've moved money from one period to the next, but your purchasing power in the future is going to be exactly the same as your purchasing power now because the interest rate you're earning is exactly equal to the overall inflation rate. So, but if it's not, if in fact you are earning a real interest, and the nominal interest rate is higher than the inflation rate, so the nominal interest rate might be 10%, the inflation rate might be 3%, then the difference is what we call the real interest rate, what you're earning above and beyond inflation in that case. So when we talk about interest rates, and one thing to understand, we talk about interest rates and inflation rates, and what we, of course, typically you talk about an inflation rate as 5%, say, but notice that in order to adjust something to figure out what the price of something will be, if the inflation rate is 5%, to figure out, and that's given by P, to figure out what something will cost in a year, you don't multiply it by the inflation rate. You have to multiply by 1 plus the inflation rate, right? It'll be its current price, which is where the 1 comes in, plus an additional 5%, if that's in fact the inflation rate. So therefore, what we mean is when we talk about the relationship between the nominal interest rate and the real interest rate is given by the adjustment that you get from the nominal interest rate is 1 plus I. That's equal to the adjustment you get if you were to inflate something by the inflation rate, or 1 plus P, multiplied by the what you earn as a real interest rate of 1 plus R, right? So 1 plus I equals 1 plus P times 1 plus R, right? So that's really again, the idea of nominal equals real times 1 plus P, where P is the inflation rate. Now, to approximate that, if you multiply that out, so you can sort of do the math, and you could, if you did the algebra there, you would get I equals P plus R plus P times R. But P times R is generally going to be something very small, right? If P is something on the order of, inflation on the order of 3, 4, 5%, interest rate, the real interest rate is likely to be something on the order of, maybe 3%, 4%, up to 10%. But your bottom line, you're talking about multiplying like 5% times 5%, right? And 5% of 5% is, 0.02. I mean, it's a very small number. And so it really ends up, and we often approximate the nominal interest rate and say I is equal to just simply the interest rate plus the real, we say that the nominal interest rate is simply equal to the inflation rate plus the real interest rate of R. So I equals P plus R. Okay, sort of to see how the math works out in this. Suppose that you in fact are given future benefits or costs in nominal terms, right? And that the inflation rate for now, P, is constant. Now, again, remember initially I mentioned to you in our example that the future benefits and costs were given in real terms in FY 2015 numbers, or FY 2015 dollar values. That isn't always the case. So suppose that's not the case. Suppose, in fact, you're given future benefits and costs in nominal terms instead of real terms. In that case, you have to adjust for inflation. So if we say that we have a constant inflation rate, suppose the inflation rate is 3%, right, which would mean that P, in this case, is 0.03, right? And remember that that nominal equals real times 1 plus P, which would mean that real equals nominal divided by 1 plus P. So therefore, for benefits or costs that are 1 year from the base year, we would calculate the real value by, if we're given nominal values, divide that by 1 plus the inflation rate. If it's 2 years from now, we have to adjust for 2 years of inflation. So we would do the real value equals the nominal value divided by 1 plus P squared. And of course, if the benefits or costs are T years from now, then it's simply going to be the real value equals the nominal value divided by 1 plus P to the power of T, where T is the number of years from the base year. Now, of course, inflation may be differ year from year, and you may have a forecast for inflation to be relatively low in the next few years, but increasing over time. And therefore, the inflation rate in year 1 may be different from the inflation rate in year 2, so on and so forth to the years you're projecting. So in that case, you actually have to do the real value is equal to the nominal value divided by 1 plus P1, where P1 is inflation in the first year, 1 plus P2, where inflation that's inflation in the second year, etc. All of those 1 plus P1s, 1 plus P2s, etc. in the denominator. So for each year, you're dividing by 1 plus the interest rate for that year. Now, what value should you use for future inflation in your cost-benefit analyses? Well, we have some guidance again from OMB Circular A94, which gives us our overall process guidance, if you will, or the economic or guidance for federal government cost-benefit analyses. And that document says, quote, when inflation assumption is needed, the rate of increase in the GDP deflator from the administration's economic assumptions for that period is recommended. For projects that extend beyond the 6-year budget horizon, right? So in particular, the administration's economic assumptions often or generally only go out to a 6-year projection inflation. And they will be different you'll get a different projection for each year, potentially. However, what we can do is if you have a project that extends beyond the 6-year time frame, assume in year 7, 8, 9, 10, however it is, that the inflation is the same as, so again here it says inflation assumption can be extended by using the inflation rate for the 6th year of the forecast. And note that this forecast is updated twice annually, at the time the budget is published in January, February, and the time of mid-session review in July. So you can get the most recent forecast for your cost-benefit analyses based on those updates from the administration. Now, of course, as we talk about the idea of nominal and real, what sort of terms should you report in a cost-benefit analysis? Well, ideally you should either keep everything in nominal or keep everything in real. Right? Don't switch back and forth. Don't have some things in real terms, some things in nominal terms, and get very confusing. So you could use a nominal discount rate. You could, and we'll talk about discount rates shortly, what we mean by that. It doesn't just include inflation, for example. So you can keep all the values in the discount rate in nominal terms, or you keep all these in real terms, inflation adjusted, but don't mix the two. Now, in general, it's easier to convert everything to real terms, and that way, you sort of, first of all, you've done, of course, some of the work for whatever analyst there will be, and also it makes sure that everything is consistent. If everything's in real terms, then everything is comparable apples to apples. And you generally would use the dollar value from the base year of the program. So if it starts in 2015, then discount everything, adjust everything to reflect, FY 2015 dollars. Now, on the other hand, when you're presenting a budget, right, for future years, in that case, you want to have the dollar outlays for any year to actually be in nominal terms, because again, budgets are done in nominal terms. What's the budget we need in FY 2018? Putting those in real terms is going to be misleading, because again, the budgeting is going to be done in nominal terms. So ideally, if you're going to be comparing things over years and combining them into one sort of apples-to-apples comparison, do the benefits exceed the costs, or which option has the highest net benefits, the best thing to do is to have everything in real terms, so that you can actually compare costs and benefits across years. Otherwise, you have to discount them and discount different years with different discount factors. However, if you're talking about in budgeting purposes, not in terms of the decision to be made, but what's going to have to be budgeted. In that case, of course, you have to convert them into actual outlays in terms of nominal or current year dollars. In other words, dollars for that budget year. Now, going back to our problem, our alpha versus beta helicopters. Suppose the inflation rate is 3%, right? I already told you that the O&M costs. First of all, notice that the costs you were given the R&D costs, which are sunk costs, which are in some sense irrelevant for the decision. You're given the procurement cost, which is already in FY15 dollars, because it's been in FY15, and you were told that all future O&M costs were given in FY15 dollars. Now, if they were instead the O&M costs were not discounted, so they were given in current year dollars rather than FY15 dollars, they would be approximately, as shown here. Instead of being, for example, for alpha, instead of being $50 or 50 million every year for the first 3 years and 100 million for every year for the last 3 years, it would be 50, 51.5, 53, 109, 113, 116, approximately. And one thing I asked you to do, a question or exercise to do, is to use Excel to adjust these O&M costs for inflation. and basically show that that would give you the exact same results. Now, I actually didn't, in the spreadsheet I posted online, I didn't have these numbers in there for you to do it, but I can show you how that would work in Excel. So let me actually, if we can see those numbers there. If you look at the, so here looking at the spreadsheet, if we looked at the spreadsheet and we looked at the tab under inflation, you can see, if we, instead of these numbers here, you can see if I put in, for example, negative 51.5, negative 53, negative 109, negative 113, negative 116, and then for beta, of course, negative 103, negative 106, negative 55, negative 56, negative 58. Of course, these totals wouldn't be the same, but what you can see is if you look at the, in that I've allowed you to adjust for the inflation adjustment, and you can then see that you get, with those numbers, you get, certainly rounded to the nearest million, the exact same values that you got before, right? Which was what you were tasked or asked to do. Right, and just undo it and go back to the original numbers there before going back to our PowerPoint slides. So again, if you were given the values in the O&M costs in nominal dollars instead of real dollars, that's what they would look like. You know, at least rounded to the nearest million. Although in FY16, you'll notice that I did it to the nearest $500,000. So what we're going to do is hereafter in this exercise, we're actually going to, just so we can incorporate inflation considerations, we're going to assume that those original O&M costs, rather than assume that the nominal costs are as given here on the previous slide, and therefore the original costs were in fact real, suppose the original costs you were given were actually, in fact, nominal costs. So it was going to be $50 million, for example, for the Alpha helicopters, $50 million each of the first 3 years in O&M costs in nominal dollars for that year. So $50 million in FY15, $50 million in FY16, $50 million in FY17, right? And then now, if we suppose we have that 3% inflation rate, right? Figure out how that would change the total life cycle costs, right? And again, only focusing on inflation right now. We're not going to adjust for anything else. No discounting yet. And what we mean by discounting as distinct from inflation, adjusting for inflation, we'll get to in a minute. How would it change the recommendation? Well, if we go to that tab where I had inflation, and again I put in here the interest rate of 3%, you can see that at an interest rate of 3%, before the original here at the top, we see that the decision was to go with the beta helicopter because beta was in fact the less expensive, $850 million versus $875 million. When we looked at those and assumed those numbers were in fact real numbers. Now, if they were nominal numbers, we have to adjust for inflation, and so we do so. You'll see the formula, and I've assumed a constant inflation rate, and you can look at the formula in the cells if you want, and you sort of see that what we've done is again looking here. If you can see the formula here, I've taken in each case I've taken the nominal value divided by 1 plus the interest rate raised to the power of the year, and of course what we're doing is the year is I've put in here, used again 0 for the base year and 1, 2, 3, 4, 5 for the out years, and now you can understand why I've numbered the years as such, because it allows for the formula to very easily sort of, as opposed to if you made this year 1, 2, 3, 4, 5, 6, you would the formula in these cells here would be the exponent would have to be whatever that year is minus 1. So it actually makes it easier in that regard. And now you see these numbers are all lower. All the O&M numbers are lower than what's given up here at the top because of they are adjusted downward for inflation. Notice there's no adjustment, obviously, in year 0, although the formula is there. When you divide it by in the denominator, 1 plus the inflation rate raised to the power of the number of year. Well, the year is 0, so anything raised to the power of 0 is simply 1. So that's why, even though the formula is actually the same, here in those cells in column D, the numbers are unchanged. So now, in summing up those now inflation-adjusted numbers, you still get the same conclusion in terms of the beta being the less expensive of the two options. But I also asked you to, what happens if the inflation rate is 8%? So you can put in here 8%, change to 8%. Notice now, suddenly, with an 8% inflation rate, that now notice that the less expensive option is if actually alpha, right? It switches from alpha to beta. I'm just doing undo and redo, and you can see how those numbers switch when you change it. So at an 8% inflation rate, alpha is actually less expensive. Now, why is that? Why does it switch from one option to the other just by raising the inflation rate? I mean, it makes sense, of course, that the numbers would get obviously an 8% inflation rate. Notice this is, notice that these numbers here all in absolute value terms get smaller, right? So this is here, for example, negative 68.1 in year 5, as opposed to what 3% interest rate, it's negative 86.3. But and again, that's because you are disinflating or deinflating or deflating future numbers to an even greater degree. But why is it that so it makes sense all the numbers get smaller, all the future costs and future benefits get smaller because of the higher inflation rate. But why does the option of alpha versus beta change? Well, the answer is because if you look at the O&M costs for alpha and beta, alpha is much more weighted to the future, right? So alpha's has negative $100 million for the final 3 years, whereas beta has the cost of $100 million for the first 3 years and only 50 for the latter. So alpha has more of its costs in the future. Therefore, if these are nominal costs, so then discounting the future even more discounts alpha's costs even more so than it does discount beta's costs, because more beta's costs are in current or near term dollars, and therefore you can see that will cause a switch one way or the other. So again, it's showing you the importance of discounting or adjusting, I should say, for inflation, right? Because depending upon the inflation rate, your decision could go one way or the other. If you did not adjust for inflation, right, we would, for example, choose beta. If you adjusted for the inflation, had a low inflation rate, again, you would still stick with beta, but a 8% or larger inflation rate in this case, right? If I put in, say, 10% inflation, it's even more so that alpha has an advantage in terms of cost. So again, this illustrates why it is important that we in fact adjust for inflation. So the next topic, so inflation is actually, as we mentioned, only one of the two key reasons that we say that $1 in the future was less than $1 today. The second reason is the opportunity cost of money. So, which leads to the idea of discounting. So really, the next 3 bullets, in some sense, are about this, about the opportunity cost of money. So, let us think in terms of $1,000 next year versus today. Right. So because of inflation, we've already sort of said, we understand that $1,000 is worth more today than it is next year. But what if there was no inflation, right? What if the inflation rate was 0%, right? Think about it. If I said, if there was no inflation, would you rather have $1,000 today or $1,000 next year? Even if there was, with no inflation, right? Well, I would presume and hope your answer would be, yeah, I'd still rather have $1,000 today than next year. Well, why, right? It's the purchasing power will be the same now versus next year, right? It's not that you can buy any more because you have $1,000 it's not like $1,000 today versus 1,000 next year will actually be able to buy anymore if the price level is the same. But you'd be able to buy it today, right? Or if you didn't buy it today, you'd be able to invest it today, right? So you could invest it for a year, right? And you would earn whatever interest, whatever returns you could get over the year, right? And so a year from now, you would have more than $1,000. So again, if there's no inflation, you would have $1,000 today does have greater purchasing power in the sense that you could invest it, right? And in 1 year from now, you would have more than $1,000, right? And therefore, you'd have greater purchasing power. Or alternatively, would you rather buy? Think about it. So, would you rather buy a $1,000 TV today or $1,000 TV a year from now? So forget about investing. But clearly, the consumption value. I would rather have the additional year of a use of that TV, right? If I was, if instead of paying you in cash, I was paying you in sort of constant value goods. So if you think about purchasing power, constant purchasing power, right? And by the way, again, when we're saying no inflation, right? You might think, well, wait a minute, TVs are getting cheaper and cheaper over time, so $1,000 can buy a better TV in a year. No, in that case, in that industry, what you're really talking about is deflation, right? That TVs, or at least a given TV, is going to be cheaper a year from now then. So it actually would be negative inflation. So again, we're assuming zero inflation here. So $1,000, what you can get for $1,000 type of TV you can get for $1,000 today is the same as the type of TV you can get $1,000 next year, right? Would you rather have that TV now or next year? Well, the answer is clearly next year. And so even without inflation, $1,000 today is still worth more than next year. And why is that? Well, the idea is that's what we call the opportunity cost of money. Sort of the idea is when we do cost benefit analysis, we must estimate the true money value of all impacts, and impacts being benefits or costs, right? So not only does that mean adjusting for inflation, but also means adjusting for the opportunity cost of money, right? And so when you think about the numbers you're putting in a cost benefit analysis, it's got to answer the questions. What if you had that future money today, right? Or what if you invested the money in the best alternative? Right. Those are the ideas. Remember, opportunity cost is in all costs, we said, in all benefits really, should be measured in terms of opportunity cost, in terms of what is the next best alternative foregone, right? What's the value of what we could do with that money otherwise, right? When we said, you may remember from last time when I asked about what's the cost of, if you think about what's the cost of I think the example we used was a field on a base being used for tank practice, and if you get $1 million worth of value because of tank exercises, what should you think in terms of the cost if you use that for something else? Well, the answer is $1 million. But if somebody offers you $1.5 million, $2 million, then that will change the opportunity cost of the exact same parcel of land, right? So it's again, what is the best alternative? Well, in this case, the best alternative for that money might be consumption now, buy the TV now, or it might be investment, to raise what you can consume later, right? And so when we think about the idea that of the true money value of impacts, we've got to think in terms of opportunity cost of money, right? The idea is that resources have a cost in terms of borrowing and in terms of the alternative investments that for which they could be used. So because of this, because money has an opportunity cost, right? Not just inflation, but an opportunity cost above and beyond inflation, right? That means $1,000 in benefits today is better than $1,000 in benefits next year, right? And $1,000 in cost today is worse than $1,000 in cost next year. I'd rather incur $1,000 of costs next year than this year. I'd rather have $1,000 of benefits today than next year, right? And what that means, therefore, is as we saw with the alpha and beta helicopter example, the more that the things are weighted in the future can affect versus the present can affect the relative value. So again, the more benefits are weighted towards the present rather than the future, the higher the net benefit. The sooner you get the benefits, the better. The more the costs are weighted towards the present rather than the future, the lower the net benefit, right? So you'd rather pay the costs in the future as opposed to in the present. Which leads to this idea of discounting. How do we adjust for the fact that money has an opportunity cost? And the answer is by discounting. So to adjust for the opportunity cost of money, we're going to discount the value of future costs and benefits, right? And the discount rate, which we'll talk about, indicates the opportunity cost of money. So if the opportunity cost of money, right, what's the additional value you get from, typical consumption now versus consumption a year from now. In other words, getting the TV now as opposed to waiting a year to get the same TV. Or, what do you get? What could you get if you invested the money, right? Those two answers, right? If it's worth 10% more to you to have it today as opposed to next year, then your discount rate should be 10%. If you could earn 10% in your best alternative investment, then your discount rate should be, again, 10%. What is the opportunity cost of money? Whether it's consumption or investment, the idea is what's the best you could get. If the benefit of having the TV today is 5% more than having the TV next year, but you could earn 10% on some investment, then you pick the higher of the two. In other words, what's the opportunity cost? Is always the value of the best alternative foregone, right? And that is, so the discount rate should be equal to the opportunity cost of money, the value of the best alternative foregone, and it is the rate at which costs and benefits in the future are discounted, right? And everybody has a discount rate, right? When I think about it this way, sort of a mental exercise, the idea of, would you rather have $1,000 today or $1,000 next year, right? A year from now? Well, presumably you'd say $1,000 today. What about $1,000 today or, $1,050 a year from now? If you'd still rather have $1,000 today, then that your discount rate is at least 5%. What about $1,000 today versus $1,100 next year, right? Okay, well now you're willing to give up 10%. If you say you rather $1,000 today, then you're discounting by 10%, or more. So again, you can sort of see that if you think about that on a personal level, that choices you make reflect your discount rate. And by the way, one of the problems when we get to the behavioral issues is that individuals tend to discount too highly. They tend to, and this comes in a problem in the military in that, a problem or, certainly a situation to deal with is the fact that, why do we have so much deferred benefits in the military in terms of the retirement plan, etc. Because in many cases, for better or for worse, service members do not fully appreciate the real value of deferred benefits. And sometimes if you calculate their discount rate and you say, for example, what would you be willing, what would I have to pay you today for you to give up all rights to your military retirement? If you figure that out, sometimes you'll find out they have very high 20%, 30% discount rates, right? And that's pretty remarkable, right? You may think that because that's clearly a 20%, 30% discount rate doesn't really make a lot of economic sense, but people do that, and so in some sense, part of what we do as a military is that we look out for your best interest because we know that service members are going to discount the future. Why do we have retirement programs with mandatory contributions in general in society? It's because people don't discount properly. They don't save otherwise. So we force them against their, in their best interest, but against their own, individual impulses to save money now, right? And the more you care about the future, the more forward-looking you are, the more patient you are, right? Then the lower your discount rate is going to be, right? But the more impatient or present-focused you are, the higher discount rate is going to be, and the more you're going to want something today, right? Because and it may seem, like I say, as I talk about these huge discount rates that individuals might have, it may seem, silly. But then if I told you, even if I told you, would you rather I can give you $20 today, or I can give you, $21 next week? A lot of people, would say, oh, I'll take $20 today. $1 next week. I'd rather have the $20 today as opposed to waiting and get $21 next week. Well, if you think about that, right, you're giving up 5% interest in 1 week, which again, if you do the math, is a huge interest rate that you're willing to forego. And so individuals, probably yourselves, certainly myself, I know, don't make the best choice in terms of saving for the future. But as an organization, when you're doing cost-benefit analysis for the Army or for the federal government, you got to think about what's the appropriate rate is for the federal government or for the Army. And in general, that choice of rate, right? Obviously, the higher the discount rate, again, this idea of that being more present focused, right, will give much more greater value to costs and benefits that occur more quickly, right? And therefore, products that have sort of a delayed benefit, right? Relative to cost will have a lower net returns, and so benefits tend to come in the future, costs tend to come much more in the short term, benefits more in the long term. Well, the longer that long term is, right, the lower your net benefits or net returns are going to be. So I've already sort of suggested that individuals probably make what I would call irrational, or not, sort of have discount rates higher than they would should, quote unquote, should have. Certainly discount rates that when they get to the future will say to them, oh, it was too high. I really wish I would have saved more money. But so how do we choose the appropriate discount rate, for example, for our projects, or for any projects in cost benefit analysis, but in particular for your work as an Army doing Army CBA? Well, first of all, the proper discount in general will depend on whether the benefits and costs are measured in real or nominal terms. Obviously, they're in nominal terms, right? Then you haven't adjusted for inflation. So your discount rate has to include inflation adjustment as well, right? So if you have things in nominal terms, you're going to have a higher discount rate because you've got to adjust for inflation and the opportunity cost of money, right? But if they're in real terms, you will use a real discount rate as opposed to a nominal discount rate because the numbers are already adjusted for inflation, right? And of course, as we say, ultimately the proper discount rate is always whichever discount rate accurately reflects the opportunity cost of money over time. Now, before we get to sort of the government or the Army perspective or the public projects, what does that mean for a private firm? Well, for a private firm, the proper discount rate generally reflects the after-tax rate of return, basically what they could get otherwise. The idea of, if we didn't spend the money on this project, we would spend on another one. What's the rate of return? And that's about figuring out what the best alternative use of funds is. What's the best alternative that business has? What else could that business do? And what would be the return from the alternative? If generally speaking, for example, a lot of firms will, you could look at sort of the market overall. Obviously, any business that any private firm could, instead of investing in something, could put their money in obviously treasury bills, which are sort of guaranteed return, but certainly in an index fund, which is pretty guaranteed. And of course, when the stock market goes up and down, but it's relatively low risk if it's diversified over the entire market. But they'll often look at what is their sort of quote unquote hurdle rate, which is often based on what they usually get in terms of return on their own investments. And they will often say, if generally speaking they earn a 10%, something along those lines, 15%, depends on the firm, to return on their investments, then they're not going to put money towards anything that would they think would earn lower than that, right? Because the alternative is, generally speaking, they can do better than that. And so that's sort of how the private firm thinks about it, right? But we don't think about sort of the returns and profits and investments in the same way we do in the public sector, right? So how do we think about discount rates for government, right? Well, there's a number of different ways, but they tended to be guided by one of the first two, but then we'll talk about the third. But often it is by returns to the private sector, right? Why should the government discount the future any less than the private sector? After all, it's always an option. The government can take tax revenues or whatever and can put them they can invest in an index fund as well, right? The money we put in Social Security isn't just sitting there, right? It's not necessarily being put into its best use, but it's not that money that is being quote unquote saved for the future is just sitting there under a mattress, right? The government does invest this money. In fact, T-bills, treasury bills, that is the government investing. The government is borrowing money, right? And they're having to, pay that amount. I'm sure the interest rate in terms of return. There's also the social discount rate. We'll talk about what we mean by that. And then I'll talk about, sort of generally there's, you don't have to make much of a choice because it's given to you by policy. And we'll talk about what the government discounting is in practice. So first, in terms of government discount rates being given by the returns in the private sector. So if we were to, should we in fact match discount rate to the returns of the private sector, right? In effect, you're assuming that the money that is raised to, for example, spend on a project would otherwise have been invested in some private sector project, right? So just like any company can choose to invest when they raise equity or they raise debt, to invest in some initiative, we could get in on that game. We certainly can buy stock in firms. We can certainly buy bonds in firms that are used, which have a particular rate of return. But however, the idea is, if you think about it, that when money that the government raises, what would it have been? Again, going back to the notion of opportunity cost, what would it have been used otherwise for, right? Now, the government, and we want to think about the idea is that what if we didn't raise that money? What if we didn't have a tax? Well, the tax could have been on, on expenditure by firms or individuals. Either individuals would save that money, right, which saving then gets borrowed and used for investment, or it could have been money that the business would have invested, right? Things that aren't taxed, or at least taxed at a different rate, right, as opposed to consumption, right? That if I paid lower taxes, maybe I would have more TVs, right? And money that I would use for consumption is taxed. So now the issue becomes, how do we adjust for the after-tax discount rate, right? Because the idea is that again, if it was consumption, right, then that money would have otherwise been used for consumption, but some of that would have been taxed. So it gets complicated here, right? Because the idea is that when you got to think about whether we should adjust for tax effects or not, when looking at private, balancing government discount rates to private sector discount rates, the problem becomes understanding that the tax implications, are different, and you almost would have to figure out where the money is coming from, that you get in terms of tax revenue that is ultimately used, for funding federal government projects. So what about this idea of, so now that said, just so we're clear, and you'll get to it when we see in practice, there is some effort to, when we get to the recommended or the what's done in practice by the government, you will see that it is tied to or related to returns to the private sector. But it also thinks about, in terms of sort of the self-interested perspective of returns to the private sector, there's also this idea of the social discount rate that tends to guide government discounting. What do we mean by that? Well, the social discount rate is the idea of, just generally speaking, right, what is the valuation society places on consumption that is sacrificed in the present, right? Because for any if the money is used for some government initiative, what if that money was used for something else, some other thing for the benefit of society, right? It may not be, again, it could be different from the private sector returns because it's not sort of self-interested, right? It's not about, what is the return. The private sector return would be what is the return that business could get or that individual could get if they had the money, right? But it's concerned about, for example, society as a whole, future generations. We talked about this idea of paternalism, right? Remember, the paternalism is the idea that people don't necessarily know their own best interest, right? And if I asked you what your individual discount rate is, individuals tend to actually discount too highly, and they don't think about the future as much. And so paternalism means that as a government, we need to plan for the future more so than individuals would, because frankly, we believe that individuals plan suboptimally. But also, there might be some idea of a benefit besides the idea that, the private use of these funds. There might be, by solving some market inefficiency, whether it be because of externalities or public goods or monopoly problems. We talked about these market failures, right? Then there might be a greater benefit to using that money for a social reason as opposed to allowing individuals to sort of, instead of spending that tax revenue, give it back to society. The private market might not use those funds in a way that is as efficient as the federal government. Now, of course, the government use of funds and efficiency may not sound like they go hand in hand, but here I'm talking about economic efficiency, not sort of operating efficiency, right? But the idea is that the private sector firms can't the private market will not fix problems of externalities, of public goods problems. The private market sector will not correct for monopoly issues, whereas that's a sort of inefficiency that can be done with public use of those same funds. So these are another ideas of guiding what we ultimately will use as a government discount rate. So then what does that mean in terms of practice? What are actual sort of the government discount rates that are actually used in practice? Well, the answer is there are several, but I'll ultimately give you an answer that you should use in your own projects. So if we look at, in practice, sort of discount rates are used in the American government, right? Here are some examples, right? OMB, and we'll get to that, talks about 7%. Bureau of Land Management, 10%. The GAO uses the average cost of Treasury debt, which changes over time. So again, you can sort of see that depending upon the level of the agency, the purpose, there can be a variance, right? So even then, we don't get necessarily a clear answer. However, the OMB does recommend a use of a 7% discount rate, for all public investment projects. And when in doubt, that's the rate that you should use, right? Where does 7% come from? Well, it's sort of an estimate of the historical pre-tax rate of, return on private investment. So it is tied to, again, private sector discount rates, right? The pre-tax rate, because again, the federal government doesn't have to worry about sort of paying taxes because they'd be paying them to themselves. Some agencies use a 2% or even, or a lower at least, real return number, but that's sort of intended to measure the after-tax rate, right? So the recommendation then that I give you, and that we have in this program, and that comes from OMB, is that you should use that 7% rate. In particular, if you have a constant dollars, if you have all your numbers are on constant dollar, dollars, so you already adjusted for inflation, then you should use a real discount rate of 7%. That's a real discount rate, not a nominal discount rate. So that's the rate you use after you already adjust for inflation. Now, that said, you should probably point out what if the discount rate was higher or lower, if it has a big effect. So again, remember, sensitivity analysis is part of the stages of any cost-benefit analysis, so much so that I actually recommend it to be a separate, distinct stage or step in the process. And so what you might want to do is you might want to, particularly when it has an effect, if it doesn't have much of an effect, it's not as big a deal, but you might point out, that, hey, if the discount rate was 5%, we would recommend something different. If the discount rate was 9%, the recommendation might change. Where the recommendation would change with a small change in discount rate, you should definitely indicate that. In fact, you could have a table that says for different discount rates what the net present values are for the different options, right? At the very least, it's sometimes helpful to indicate what we call sort of this threshold, this idea that how much would the discount rate need to be off to change our conclusion. And so even if you might want to say the discount rate would have to be 12% for me to choose, this other alternative, right? Just like we saw when we just doing the inflation, no discount rate, but the inflation rate, we could see how high inflation had to be for us to recommend alpha as opposed to beta as a helicopter design. Same idea here is that adjust for inflation, and then when you use a discount rate, which, again, there might be different reasons to use a different discount rate. By telling the person reading your CBA, how significant a change in discount rate would have to be for you to change your recommendations can be very helpful. So if we use a 7%, what does that mean? Right? How should I interpret a 7% discount rate? Well, the idea is, think about this. If you use a 7% discount rate, that means that $100 10 years from now is worth only $51 today. So 10 years from now, so basically a 7% interest rate, something 10 years from now is worth only half today, right? 20 years from now, it's worth only a quarter, right? You'd rather have a dollar 20 years from now than a quarter today, or I guess that's not exactly true. A quarter today is approximately 26 cents today is worth $1 20 years from now at that rate, right? And so again, you can see that, farther out in the future, right? 30 years from now, it's only $13, right? All right, so make sure you see if you're following along so far. Test your understanding would be, would future benefits be worth more or less with a 5% discount rate if you had a lower discount rate? So think about that for a second, right? 10 years from now, we said that $100 with a 7% discount rate, 10 years from now, $100 is worth $51 today. Well, what if the interest rate was 5%? Would that number be bigger or lower than $51? Well, and the answer, of course, is that the future benefits would be worth more at a 5% discount rate, because the lower the discount rate, right, the more important the future is. The more higher your value in the future, the less you're discounting the future, right? And therefore, benefits to the future become worth more. Right? So if we did 5%, the number $100 10 years from now would be worth more than $51 today. So with that idea of discounting in general, now we can talk about more specifically the idea of getting to the idea of, okay, what does that mean for how we calculate the net benefits of any course of action, any COA? And we do so by using this notion of ultimately net present value. But we're going to get there step by step, right? We're going to go through the present value as opposed to future value. We talk about the future value of an individual cost or benefit, the present value of an individual cost or benefit, the present value of a stream, and ultimately the overall NPV of a course of action. So the idea of the present value of future benefit or cost, right, is the value of that benefit or cost that you would need to receive or incur today. So let me read this just as a benefit first, and then I'll read it again as a cost, right? So the present value of a future benefit is the value of the benefit we would need to receive today in order to have a gain equivalent to receiving the same benefit at a given time in the future, right? So again, the present value of, say, $100, 5 years from now is equal to how much would I have to receive today to have a gain equivalent to what I gain when I receive $100, 5 years from now. Right? But it also applies to cost. So again, reading this again in terms of cost, the present value of a future cost is the value of the cost we would need to incur today in order to have a loss equivalent to incurring the same cost at a given time in the future, right? So if I have to incur a cost of $100 5 years from now, what is the cost today that I would, if I incurred it today, it would have the same loss, the same negative effect as a cost incurred 5 years from now. And again, remember, cost in the future, we'd rather have a cost in the future, but have a benefit in the present. So the idea there, even on the cost side, is that $100 cost 5 years from now, the equivalent cost today is going to be a smaller number. Right? Again, we're going to discount the cost and the benefits the same way. And ultimately, what present value is, therefore, is the value you ultimately get when you adjust a future impact using discount rate, whether it's a cost or benefit, apply the discount rate. What you get, when you apply the discount rate that we already talked about, is the present value. Right? And if you combine the present value of all costs and benefits over all years, that gives you the, quote, net present value of a course of action, which is actually, as you'll remember, the last bullet from the previous slide. And so where we're ultimately going to end up. But we're going to get there in a sort of logical way, and we're actually going to introduce this idea of future value to ultimately get to present value. So what is future value? Well, future value analysis, right, is asking questions like the following. How much would I need to receive next year in order to be willing to give up or invest an amount X today, right? So if I had to give up $100 today, how much would I have to get in return next year to be willing to give up that $100, right? And so in that sense, again, obviously, I'd have to get more in the future, right? So the future value is equal to X that I give up today times 1 plus R, where R is the discount rate, right? So if R is, the 7% we talked about, the future value is going to be X times, for 1 year from now, X times 1.07, right? Which is going to give you a larger number, something larger than X. So the future value of something is going to be a larger number, right? The future value of, if X today has a future value that's larger than X. Present value says, well, how much would I be willing to pay now in order to receive an amount Y next year? Again, I'm using Y's so we don't confuse X's and Y's here. But suppose I was going to receive $200 next year. How much would I be willing to pay now to get $200 next year? Well, I'm not willing to pay $200 now to get $200 next year. We already know that $200 next year is worth less than $200 now. But I'm willing to pay something. I would pay $100 now to get $200 next year, right? But what is the exact amount? Well, the answer is whatever the discount rate is, right? It's actually now the present value is equal to Y, that future amount, divided by 1 plus R. Right, divided by the 1 plus discount rate. So divided by 1.07 when we use a real discount rate of 7%. So the present value is going to be again, we're dividing Y by 1 plus R. So present value is going to give you a lower number. The present value of Y, which is in the future, is lower than Y. The future value of X, right, which is x the current amount, is greater than x, right? So future value is going to be greater, present value is going to be less. So let's talk about, again, the study of future value. What's the future value of an individual cost or benefit? How do we think about that? Well, suppose you invest $100 today, right? So this is sort of the idea of future value. Again, I don't want to skip over the headlines here, right? The future value is the idea of projecting present dollars into the future. So suppose you invest $100 today in the bank and you have a 5% interest rate, right? Well, then after 1 year, your investment will be worth $100. But you get additional 5%, which is $5. So it's actually, do the math, it's 1 plus 0.05, right, times $100, or $105, right? After 1 year, you get $105, right? After 2 years, that $105 would get another 5%. So now it's 1 plus 0.05 times 105, which comes out to 110.25, right? And this is the idea of, so notice that, by the way, you get $5 that first year. You get $5.25 the second year. You'll get even more the third year, right? So it's not that you get the same amount of interest each year, because you're getting interest on your interest, right? And that's the idea of compounding, right? The interest compounds over time, right? Because the interest is also earning interest. And that's how we project, again, into the future from present day dollars. So mathematically, more generally, if X is the initial investment amount, right, and R is the rate of return on investment, in other words, the discount rate, your opportunity cost of money, and T is the years of investment, then the future value of the investment is going to be, remember, future value is going to be larger than the present value, right? So therefore, it's going to be X times 1 plus R to the T, to the raised to the power of T, which is T is the years of investment. Right? And that's the formula for the future value. You give me a current investment amount today, a rate of return or discount rate, and when we're actually going to get when I'm going to get the future payment, I can tell you what the future value that I have to receive in order to be willing to give up X today, right? And it's given by that formula: future value equals X times 1 plus R to the raised to the T. Again, where did that come from? Looking back again, notice that it's 1 plus point here with the 5% rate. It's 1 plus 0.05. If it's 1 year, you multiply it by 100 once, but then you multiply it by 1 plus 0.05 for the second year. If you do that for the third year, you do 1 plus 0.05 again. So it's going to be 1 plus 0.05, times 1 plus 0.05 times 1 plus 0.05, for every year that you let that investment earn the interest. And so it's going to be 1 plus 0.05 or 1.05, squared, cubed, to the 4th power, to the 5th power, to the T power, if it's for T years. All right, so with that in mind, knowing, again, let me just put this in your head, future value equals X times 1 plus R raised to the power of T, right? So if you have X in the present, the future value of that, in other words, the amount you would have to receive in the future to be willing to give up X today, is X times 1 plus R raised to the T power. Well, with that in mind, seal that in your mind, what is that? How do we get the present value of an individual cost or benefit? Well, remember, actually, I guess you don't need to seal it in your mind because it's actually on this slide here. Remember that the future value, so now, whereas future value was present dollars into the future, now we're going to do future dollars into the present. The future value of the current investment X in year T, we already said was given by future value equals X times 1 plus R to T. Or in other words, future value equals present value times 1 plus R to the T power. Thus, again, just doing algebra, present value is equal to future value divided by 1 plus R to the T power. Remember, 1 plus R to the T power is something greater than 1, right? Even if it's just 1 year, it's going to be, for example, if R is the 7% discount rate we talked about, it's 1.07. So, again, present value is going to be something smaller than future value. Hence, we're discounting. We're discounting future values to get present values. So, again, here's the companion sort of slide to how we had the general idea of future values that did into present values. If Y is the amount to be received in the future, and R is the rate of return on investment, or the discount rate, and T is the number of years in the future when the amount will be received, right? Then the present value of that future amount is present value equals Y divided by 1 plus R to the T power. Okay? And again, you can figure out future value, we sort of understand. We get 5% interest every year or whatever it is. If you take the inverse, that's how you get to the present value of a future cost or benefit. Now, just some vocabulary, right? Notice that we are multiplying the present value. We divide it by 1 plus r to the t, which is the same as to the raised to t. That's the same as multiplying it by 1 over 1 plus r to the t, right? And so therefore, that's this notion of the discount factor, right? So if r is the discount rate, right, then 1 over 1 plus r is the discount factor for values from next year. And 1 over 1 plus r to the t is discount factor for values in t years, right? So present value is equal to future value times the discount factor. And discount factor, again, will be something always less than 1, right? But you might hear discount rate, discount factor. This just sort of gives you the vocabulary. We'll tend to talk discount rate, but I want you to, if you hear discount factor, I want you to know what it means. And this is really, a very important concept, right? Because if you don't discount, you really are getting the numbers way off, right? So to give you some idea, think about $1 million that you're going to get 20 years from now, right? That may sound like a lot of money, right? $1 million, I'm going to get $20 million 20 years from now. Well, if the discount rate is only 5%, that's actually only worth, a little over a third, $377,000, right, today. If the discount rate is 10%, right, it's only worth, it's only worth less than $150,000. You'd rather have $150,000 if your discount rate is 10%. You'd rather have $150,000 today than $1 million 20 years from now, right? So again, particularly when you have projects that project out, over a long, stretch of time, discounting becomes very, very important. Now, so to this point, we've talked about how to discount a specific, we talked about the $1 million 20 years from now, or a cost 5 years from now, or a benefit 5 years from now. We've talked about how to do the future and present value of an individual cost or benefit. But what about a cost or benefit stream, right? Because it's not usually the case that you have a cost and a benefit, but usually you have, as we saw in the alpha and beta helicopter example, you're going to have costs, every year. Maybe some benefits every year. How do you do that when you've got a stream, not just one cost or one benefit, but a stream of those benefits or costs over time? Well, suppose you have the same value each year, right? Whether it's a benefit or cost. Suppose it's, like $50 million every year in O&M costs or whatever it might be. So again, consider a benefit of X dollars accrued every year for T years, or consider a cost of X dollars incurred every year for T years. So for the next T years, 6 years, whatever, you're gonna have the same value each year, right? The present value is going to be, you simply sum up the present value of each one of those, right? So the present value of that whole stream is going to be, what's the present value of what you receive? Let's take it as a benefit. The present value of what you receive this year, if you receive X this year, it's worth X, right? You don't discount it's now, right? You don't discount what you receive now. If you receive X now, it's worth, the present value of X now is X. The present value of X next year is X divided by 1 plus R. The present value of X 2 years from now is X over 1 plus R squared, right? So it's going to be, summing up, all of the present values, which in summation notation is given, as below there at the bottom. The idea that first, is the sum from t equals 0 to t. Remember, I'm counting current year as 0. T equals 0, again, mathematically, you can now see why that makes sense. T equals 0 to t of X divided by 1 plus R to the t. Or, since X is the same, you can actually, in algebra, take it out. It just simply, X times the sum from t equals 0 to capital T of 1 over 1 plus RT, which is just the discount factor. Remember, the discount factor for each year. So you basically sum up the discount factors for all years in question, multiply by X. That's what you get for the present value of a stream of costs or benefits. Now, of course, as we saw with our alpha beta helicopter example in general, you're often not going to get the exact same costs every year, the exact same benefits every year. So how do you do that? It's just a little more complicated, basically the same. So suppose you get a benefit of X0 accrued this year, X1 accrued next year, and X2 accrued 2 years from now, and so on for 2 years, or costs incurred, given by that, right? In that case, which is what you usually see in practice, right, that the amounts you would get or pay in the future will vary over time. Then again, you just simply do you sum up the present value. So for each individual cost or benefit, let's take it as a benefit for now. The present value of a benefit of X0 now is, of course, X sub 0. The present value of an X sub 1 received a year from now is X sub 1 over 1 plus R, so on and so forth, to the present value of X sub t received t years from now is X sub t divided by 1 plus R raised to the t power. So again, and then you can also put that in summation notation of is equal to little t the sum as little t goes from 0 to t of x sub little t divided by 1 plus r to the little t power, right? Again. And so that's how you do this, the present value of a stream of costs or benefits. So finally, putting it all together, how do we calculate the net present value of a course of action, right? Overall, if we're comparing alternatives, going back to the whole idea of what we're doing here in cost-benefit analysis, trying to figure out the net benefits or the net benefits measured in terms of, in this case, when it's involved future costs and benefits, the net present value of a course of action. Well, there's two ways you can do it. You can either, again, I just showed you in the last section how you calculate the present value of a stream of benefits or the present value of a stream of costs. Well, you could find the present value of all future costs, the present value of all future benefits, and then just the net present value will be the present value of the benefits minus the present value of that stream of costs, right? And again, you can see here, this is given for, you can see that you'd have two summations in that case, or you could have the net benefits each year, which is the benefits minus costs each year, right? So in other words, you could discount the benefits, discount the costs. You're using the same interest rate, right? I mean, there's really no real reason, or discount rate. There's no real reason to discount costs and benefits differently, right, for the same year. So therefore, you could just calculate the net benefits each year and discount those. And then for each year, instead of having, the numerator here in your summation would be the benefits minus costs, which is the net benefits for each year, and discount that. So again, either way, that's how you calculate the net present value of a course of action. Some examples, because let's suppose these are the project costs over time, right? And we sort of see that, if we will, that these first the costs, negative 50 in year 1, negative 30 year 2, negative 20, et cetera, et cetera. And so this is sort of a 10-year time frame. And let's suppose we add in some benefits. So usually, as we've already sort of said, that costs tend to be more upfront with some ongoing costs, and benefits tend to come later. So suppose this is your cost stream. Again, we're assuming that this could be real dollars, so it doesn't really matter depending whether we're using a nominal or real discount rate. But if these are nominal dollars, then you've got to use a nominal discount rate, which will be higher than your real discount rate. But suppose we have this stream of benefits given in blue and this stream of costs given in red. Should we do it? Should we do this project? Is this a net present value positive effort? Well, it depends. Again, let's suppose if we calculated that if we did a 0%, right? So we didn't discount at all. We just added them up, right? The present value of the costs would be negative 175. The present value of the benefits would be 200, right? And the net present value would therefore be 25. Right? So again, if we did not discount these at all, if we did a 3% discount rate, so we discounted a little bit, right? We would get present value of the cost would be, just the numbers we just discounted. So these are discounted each of those future costs and future benefits to be a little bit smaller, if you see there. And notice that of course, you're discounting things the farther in the future, the greater the rate. If you go from this slide to this slide, if you go from slide 50 to slide 51 there, if you will, you can see that the percentage by which those bars get shorter is greater the farther out in the future it is. But it's not by a lot. If you only use a 3% discount rate, you'll see that the present value of the cost in this case is negative 161. Present value of the benefits 175. It still makes sense with a minimal discount rate, small discount rate. It's the net present value is still positive. So if it's a go no go decision, this project makes sense. However, let's suppose we get a 10% discount rate. At a 10% discount rate, you'll see that again. You see that we've shortened the future bars even more. The bar in year 1 doesn't get shortened at all because you don't discount the first year. Right now, suddenly things that happen in the future are less important to us than they were with a lower discount rate. And now the present value of the cost is negative 138, and the present value of the benefits is 132. So now this is net present value is negative, right? And so if you add a 3% discount rate, this stream of costs and benefits would suggest yes, we should do that project. But at a 10% discount rate, that at a 10% discount rate, the net present value is negative, and so we would say no go. Right? So again, getting back to the idea of how discount rate you choose matters. Right? We recommend to use a 7% discount rate, but if I was reporting a cost-benefit analysis on this particular stream, I would point out, well, at a higher discount rate, we say we shouldn't do it. At a lower discount rate, we should, and report some sensitivity analysis on that. And I'll talk about, and by the way, in a second, I'll give you the example on alpha and beta helicopters, which is actually right here. So let's return to our motivating example of the alpha versus beta helicopters, right? And so what I suggest you do is first adjust the original numbers for 3% inflation, right? And assume that the operating maintenance costs were given in nominal dollars, as we have initially we said real dollars, but now we change it to nominal dollars. Then calculate the net present value of each design under the various discount rates. What if it's a 7% discount rate? What if it's a 4% discount rate, right? And finally, I talk about using Excel's data table command to calculate NPVs for rates from anywhere from 0 to 10%, right? And which helicopter design would you recommend under each discount rate? Well, let me show you that. So let me go back to our spreadsheet here. And so this is the tab under discounting. If you see the three tabs, it should have been 3 tabs. I think there was at one point I had an individual rate of return tab there, but I didn't put that in there I didn't want to add too much and confuse you. But but if we do the discounting here, we can sort of see again. I first suggested that with the original numbers here, as before at the top. I then suggested, so those are the original numbers, and then say adjust them for inflation by 3%. So you put in 3% there, and what I've asked you to do is look at a 7% discount rate, then a 4% discount rate. So first at a 7% discount rate. So here we have the discounting adjustment. So it's the same formulas here, by the way, as we had, for inflation adjustment. But now we're adjusting the rate. We adjust for inflation, and then we adjust the inflation adjusted rates for discounting, right? And now what you'll see is, so remember that without any adjustment whatsoever for inflation or discounting, opportunity cost of money, we had that alpha was more expensive, 875 versus beta, and our choice was beta. When we adjusted for inflation, a 3% inflation adjustment, we still ended up with alpha being more expensive and choosing beta. But now what you'll see is if you put a 7% interest rate in there, now we have that beta is actually more expensive than alpha, right? That with that, again, discounting the future costs by 7% per year, because so much of alpha's costs are in the future, it makes alpha relatively less expensive as we discount the future, and therefore we actually, at a 7% discount rate, would recommend alpha because alpha has a lower cost. But I also asked you to look at a 4% discount rate. So you put 4% in there. Notice that now so if we had a 7% discount rate, we have that alpha is more expensive. Alpha is less expensive. 4% discount rate, I think we still have alpha being less expensive. So if we did a 3% discount rate, now suddenly we get to the point where alpha is more expensive, right? And in fact, what we can do is, I probably should have asked about 3%, but we actually down here at the bottom can do it for a number of different discount rates. And I showed you here how to do sort of a sensitivity analysis. Let me actually, I'm gonna, so we can see all this at once. And by the way, there were some small typos in the original version here that I posted online, but I mean, it should have been, I assume, self-explanatory. Certainly you can look and see what I put in the cells, but I think I wrote like J20 here instead of J23. But and so I asked you to do all up to 10%. I added 10% in there. I think originally it was only up to 9%. But so if you wanted to use Excel, it's rather than, you could just simply change the interest rate. You could put 1%, 2%, 3%, 4%. But just to give you a little bit of, this is not essential learning. You're not going to be tested on this per se, but just use some, if you're not as familiar with Excel and you want to know the functionality of it. I teach a whole course on business modeling and all kinds of fun things we can do to Excel to test this. But if you want to do a data table, use a data table function. Let me show you what I did. What I can do is I can Let me clear all the values in those cells there. Let me just show you, although I give you the step-by-step directions there. Let me actually go ahead and show you what I actually did. And so what I did is set up sort of the discount rate, here from 0 to 10% on the left, the alpha, the beta, the headings there. The first thing you have to tell, we have to be able to tell it is basically what values it should report. And so here in cell I23, if I put, this is going to be the NPV for alpha. In beta, for beta, it's going to be the NPV for, I'm sorry, in cell J23, it's going to be the NPV for beta, so I'm going to set that equal to beta. And then it's going to fill it in down here, those NPVs for all different interest rates. It doesn't really matter what we put here now. This could be 3%, it could be 2%. It doesn't really matter. It'll fill it in. And in fact, because I don't want to get confusing what those numbers mean, what I actually did in the version that's online, I actually just shaded those numbers white so they wouldn't even show up. So it would be, wouldn't get confusing. But then if you highlight basically you want to get these header rows where I put in the J19 and J20, and if you highlight that entire set there, which is going to have, again, it's got the header, it's got the where the header, if you will, values there and the different rates you're going to check here. Now I'm using a Mac, but it should be, I think it's similar on a PC. I've done this in both Mac and PC, but look here under the data tab, and look under what if analysis, do data table. The input cell, there's actually, it's even more powerful functionality. You can actually vary multiple things at once. We're just varying one, so we can leave a row input cell blank. But again, in my business modeling course, we explore all the possibilities here. But look for the column input cell, put in F15, which is the discount rate. That's what we're actually going to vary, and then click OK, and it will fill in. So now you've filled in the NPV for alpha and beta for all different interest rates, right? And you can sort of see that if we, from 0% up to 10%, and we can sort of see that, okay, let's suppose I just, for visual purposes, I wanted to shade which one we chose. Well, we choose whichever have the lower cost. So here, beta has a lower cost for relatively low interest rates. And so here, let me shade those green as our choice. So we see that we would choose beta, if the interest rate is 0, 1, 2, or 3%. But then for interest rate of 4% or higher, that alpha actually has a lower cost. So again, we can sort of see how the interest rate varies. And so if you're, the optimal choice varies based on the discount rate. So, if you were doing this in a cost-benefit analysis report, you might say we assumed a 7% discount rate and therefore we chose alpha, but notice that if we had a lower discount rate, beta would be optimal choice, and you could report your sensitivity analysis in that way. So again, hopefully that example of the alpha and beta helicopters has helped you understand the lessons of this lecture on time considerations and cost-benefit analysis, and just sort of review what we've covered here, right? Remember that there are, when we take into account time in cost-benefit analysis, we actually are taking into account two primary things. There's two reasons why $1 in the future is worth less than $1 today, and the first is inflation, right? Changes in the purchasing power of money over time, and the second is the opportunity cost of money. Even if there was no inflation, you would still rather have $1 today than $1, a year from now, or $1,000 today than $1,000 a year from now, because of the the additional benefit you could get if you could use that $1,000 for consumption now, buy the TV now as opposed to buy the TV next year, or the idea that you could invest it and get a return on your investment in the meantime, right? And so we adjust for inflation by, of course, deflating using the projected inflation rate. And we adjust for opportunity cost of money by discounting. And we use a discount rate. We talked about how we chose a discount rate. And then once knowing you have a discount rate, we talked about how you would actually, get to sort of the, how you discount, costs or benefits in the future. We actually first talk about future value and how we take consider an individual cost or benefit in a particular year in the future, just one impact in 1 year in the future, or in a particular year in the future, how do we get we actually talked about the future value of going from the present to that year, and then we took the inverse to figure out the present value of a future cost or benefit, of an future individual cost or benefit. We then combine that by figuring out the present value of a cost or benefit stream, then combine those finally to figure out how you actually get the net present value, NPV, of a course of action, which is the NPV is the net benefit of a course of action when your costs and benefits occur over time. So we've thoroughly addressed that issue of time considerations in cost-benefit analysis, and next we will be talking about incorporating uncertainty into cost-benefit analysis. So stay tuned. Thank you.